tere tulemast siis meie Mandatum Life'i väiksele veebiseminarile ja aitäh, et sellel külmal kolmapäeval liitusite meiega, et natuke siis rääkida turu olukorrast ja vastutustundlikust investeerimisest. Et meil see seminar toimub kahes osas. Kõigepealt Topias räägib turu olukorrast, väljavaadetest ja peale teda siis mina räägin natuke vastutustundlikust investeerimisest. Aga tore, alustame siis turu olukorraga. I will give the floor over now to Topias so he can talk about the market situation.
Thank you, Aime, and welcome on my behalf as well. Let's put on the slides and then we can start. So my name is Topias Kukkasniemi. I work as a portfolio manager at Mandatum Life, been with the company for nearly 10 years now. And my responsibilities include managing the discretionary client portfolios as well as allocation services that we provide to our clients. And what I will talk about today is basically the market outlook, and I will try to talk about the themes that we feel are important for the whole year and not just the coming 2 or 3 months. And then we will also discuss how these themes play out in the financial markets, both in fixed income and equity markets. And of course, relating to equities, the earnings season is ongoing at the moment, so that's one of the things that affect equity prices at the moment. So we will take a look at that as well, and I will summarize with the market view that we currently have. And as said, if you have any questions, please just put them in the chat and we will try to answer them. Let's start with the market themes. I've highlighted 3 of them in this slide, and to some extent the themes we see important for this year are actually exactly the same as they were last year, but there might be some changes relating to these themes, and I will discuss them shortly. So let's begin with the first one, which is of course the coronavirus situation, and the ongoing situation relating to the pandemic is of course that the pandemic has forced different countries, especially in Europe, to put on strict restrictions on business and travel and so on, which of course short term has negative economic effects, which also of course then affect companies operating in different countries. But contrary to last year, now what has changed is basically that we have vaccines, and for financial markets this of course means that investors now have some kind of visibility into the future where the restrictions might be lifted. So right now there's kind of an ongoing battle between the virus and the vaccines, and the faster the population can be vaccinated in Europe, in the US and elsewhere in the world, the better for the economy, of course. And the logic, of course, is that the faster we reach a certain degree of vaccinated people in the population, the faster we can start lifting the restrictions and open up economies. And right now it seems that Europe is lagging behind in the vaccination rates. So European countries are not able to give vaccines to the population as fast as the US, for example. So the US is pretty much on track currently on reaching the target they have set for themselves. So the target is to give the vaccination to 70% of the population before summer. What does this mean for the equity markets and financial markets as a whole? Right now, it seems that financial markets are kind of looking beyond the negative effects of the virus short term and concentrating on the positive effects of the vaccines, which will kick in later this year. And for equity markets, what this especially affects in our view is different sectors in a different way. So last year, the differences or variation between returns in different sectors within the equity markets were historically big. The IT sector and technology companies did particularly well, while some sectors such as travel and leisure did awfully. And our thinking is that this year, as the economy is accelerating and the vaccines give the possibility to open up economies, the development we saw last year might actually turn around, or at least the sectors that suffered the most last year might catch up with the ones that did particularly well last year. This does not automatically mean that the winners last year would lose value, but we might see some kind of leveling up between the sector returns. And we will take a look at how this has developed this year in a later stage at my presentation. The second themes, which still is and has been for many years a key driver for financial markets, is central banks. Last year, as the corona crisis kicked in, central banks stepped out and started massive monetary policy stimulus to stimulate the real economy and to kind of step in as the negative effects of the virus affected companies. But the question right now is basically how long will the central banks continue to do this? So they have cut interest rates, they have expanded their monetary policy, and they have communicated that they will continue doing this for as long as necessary, but the financial markets, of course, have a tendency to look into the future and speculate what will happen in the future, because that's the one thing that affects returns. So the question is, what exactly does for as long as necessarily mean? The European Central Bank has said that they will keep their policy intact for at least until March next year, and the US Central Bank has a similar approach. So they don't see themselves cutting the stimulus just yet. But one thing that has started the speculation about this in the financial markets is inflation expectations going up. So the realized inflation currently is still low, but expected inflation going forward has risen, and at some point central banks need to react to this, as the mandate they have is to keep inflation in control. And reacting to this might mean reducing the asset purchases they are currently doing, or at least in the US, hiking the key interest rates. But as said, this probably won't be won't be done this year, but at some point this year the markets might start pricing in the first the gradual reducing of asset purchases. So basically it means that interest rates in the US would go up, and actually market rates have already started to go up, and this has effects on the equity markets as well. Reducing the stimulus and increasing interest rates are not necessarily a bad thing for the economy or for the financial markets, but it does mean that the economy, while the central bank is doing this, needs to be growing quite fast. So as long as the economy is doing fine and economic recovery is doing fine, reducing monetary policy is not automatically bad. And we have one example from the history. So during 2017, 2019, the Fed in the US was tightening its policy while the financial markets were actually doing quite okay. So the equity markets, for example, did really well during these years. All the same, as the direction of travel basically regarding the central banks at some point will be towards reducing the stimulus. It means that this year investors need to pay more attention on, let's say, on traditional economic indicators such as GDP growth, lending, and so on. While last year, basically, the only thing you had to look at after the crisis is what the central banks are doing. But that focus is now changing because of this dynamic. Then the third theme we want to highlight is the increasing demand for responsible and sustainable assets. And this has basically two different kind of drivers. So the recovery funds that have been set up, for example, in Europe, will use quite a substantial part of the overall package to finance different kind of green projects and climate-related projects. The US are expected to do the same thing. The newly elected President Biden has announced that he will introduce his proposal of a climate and infrastructure package this month, and the markets are currently waiting for this proposal. The expectation is that Biden as well is willing to put in a lot more money to different kind of green projects. So these kind of projects right now are receiving much more funding than they were a couple of years ago, and this is partly due to the pandemic. At the same time, regulation within the European Union, for example, regarding sustainable finance is tightening, or at least we can say it's changing. And this regulation will touch upon asset managers such as Mandatum Life, for example. And what it basically means for investors, private investors, for example, is that for the first time, there will be regulation on what asset exactly is considered sustainable or responsible, whereas until today, every asset manager, for example, has had the possibility to define by themselves if an asset is sustainable or not. So this change, basically the change that regulation will now define what is sustainable and what is not, will probably increase the demand for the assets that are considered to be sustainable, and it will probably, or actually it has already started partly. So last year, responsible investment was a very good theme. If you look at the returns of different assets, for example, green energy or renewable energy did very well in terms of returns last year. And our thinking is that this will only continue this year due to these two reasons. I will not spend that much time talking about sustainable investment today. Aime will talk about it more, but we will now focus on the market situation more closely. So I talked about central banks and inflation, and these two graphs here basically show you the expected inflation on the left-hand side and the actual realized inflation on the right-hand side. As you can see in the graph on the left-hand side, inflation expectations both in the US and Eurozone have already started to go up roughly 9 months ago. And in the US, they've already reached their pre-pandemic level, while in the Eurozone, the expected inflation still is kind of sluggish, lower than it used to be, for example, 2 years ago, and much lower than what is the central bank target of 2%. So in the US, the expected inflation actually is a bit higher than the central bank target, but in Eurozone we are still quite considerably below this. And the expectation here is derivative of market pricing in inflation swaps. So actual money is traded to define these rates. So this is not a forecast of a single house or person. And this is something that the central banks pay close eye on, how the market is pricing future inflation, and this inflation that we are looking at is of course long-term inflation. While the expected inflation has risen, the actual reported inflation, so the realized inflation, is still very low. It's lower than the central bank target, and partly due to the pandemic and due to low energy prices. But basically what this means is that the central banks don't have a let's say acute problem. They don't need to act right away. They still have quite a lot of time to look at where inflation is developing. Is it accelerating or not? And then change their policy based on that. But the key message basically regarding inflation is that we are taking a close look at it this year because it will be the trigger for central banks to act at some point, and probably it won't be during the next few months, but perhaps later this year towards the end of the year. Then basically the markets are of course pricing in already the probability of the central banks acting, and you can see it here on the graph on the left hand side. So this shows you the yield, so the interest rates for selected government bonds the US, Finland, and Germany. And what this is telling us basically is that in the US, the interest rates have already started to go up. So the market is already pricing in an increasing probability of the Fed acting and reducing stimulus, while in Europe the big picture is pretty much unchanged. So the interest rates, for example, in Germany, have risen a bit during this year, but in historical terms, the change is very, very small. So basically, we can say that nothing has happened to the interest rates in Europe. What does this mean for fixed income investors? Basically, it means that the expected return going forward is very low, especially in Europe, where if you invest in, let's say, safe government bonds, you get a negative return for sure. And if you want to have a positive return, you need to take at least some kind of risk with your investments. And one possibility to do that is to invest in the credit markets, so basically corporate bonds. And the graph on the right-hand side shows you the risk premium that's paid in addition to the government bond yield if you decide to invest in government bonds, in corporate bonds instead of government bonds. And what does this tell us right now? Basically, since the pandemic and the peak last year, the risk premiums have contracted quite a lot due to the central bank stimulus, both in higher risk, high yield bonds, as well as lower risk investment grade bonds. In our view, the investment grade right now is very not at all attractive. So the yield for these investments, euro term yields, are close to zero because the government bond yield is negative, and what you get in addition to that is only slightly positive. So it doesn't seem very attractive at the moment. High yield on pan-European level is kind of the same thing. We are close to historical lows in the risk premium, which means that the expected return going forward is low. There are, however, a few markets that are more attractively priced at the moment, and I have two examples of them here. Firstly, on the left-hand side, the European leveraged loan market. So leveraged loan basically is direct lending to companies. For usually companies use this to buy other companies, so M&A activity, and this, in contrast to bonds, for example, means that the loans are not rated in the public markets. So it's kind of a private market, and usually leverage loan only has a few investors giving loan to the company, whereas in a bond you have numerous investors investing in the bond of the company. The second market is the Nordic high yield market, so Nordic corporate bonds in the high yield category. We have invested quite a lot of the Sampo Group money in both of these markets, and these are also let's say, core of our client fixed income portfolios. And why are they currently attractive in our view? Basically, if we look at the graph on the left-hand side, it shows you the yield of leveraged loans in European markets and high yield bonds in the European markets over time. And there are basically 2 points I'd like to make on this graph. Firstly, the variation in the yield of high yield bonds over time is bigger than the variation in the yield for leverage loans. So the yield for leverage loans is much more stable, which means that over time there are periods when high yield bonds seem more attractive compared to leverage loans and vice versa. And right now, since the central bank policy has affected the public market so much, the yield for high yield bonds has come down. The yield for leverage loans has come down as well, but not as much. So the second point is that at the moment, leverage loans actually, even though the yield has come down, they actually seem quite attractive compared to other fixed income investments. So that's why we are currently slowly adding to leverage loans and decreasing our exposure, especially our exposure in the bond markets, especially in investment grade. The Nordic market, on the other hand, has had a higher yield over time in history, basically all the time. There are a few reasons for this. Firstly, the Nordic corporate bonds are usually a bit more illiquid than pan-European ones, which means that investors want to have more compensation when they are investing in these bonds. And secondly, as the Nordic companies are smaller than pan-European companies, usually the emissions too are smaller in size. And this means that the biggest international investors basically are, let's say, unable to invest in the Nordic high yield markets. The emissions are so small that it's basically not worth the while of looking at the companies and analyzing the companies, which means that the biggest investors in the world don't invest that much, at least in the Nordic markets. For us, of course, this is a very good thing. It's our home market. We know the companies well, and the yield over time has been better than in the European markets, and this is still the case. And also, since the companies are relatively small, many of them don't actually get a credit rating at all, so they don't want to pay for the credit rating agencies to give them the rating. The more rational thing for them to do is actually pay the investors a bit more in interest rate or for investing in the bond with no rating. So that means to investors that you are able to basically invest in the same kind of risk with a bit higher expected return. And these are two markets that we are currently investing in. So if we then move on to equity markets and start with the earnings season and look at how the earnings season so far has been for the US markets and the European markets. Let's start with US. In short, the earnings season so far has been stronger than expected. Basically, before the earnings season, the expected change in earnings in index level was -8%, and so far the actualized earnings growth has been +7%. So the surprise upwards has been quite considerable. So far, about 60% of companies in the US have reported. Over 80 of those reporting have exceeded expectations, which is slightly more than the historical average. So overall, the earnings season in the US has been strong. There are many strong sectors: basic materials, financials, technology, consumer goods, and healthcare as well. Tech companies, which have been the market darlings for quite a long time already, for this year they are basically guiding, or they are a bit more cautious when guiding for this year. So many of the big tech companies actually give a somewhat blunt guidance for this year, just paid more attention to low visibility or bad visibility going forward than they used to do. So that's one point worth mentioning when talking about the strong earnings last year. There are of course some sectors that have done badly. Travel and leisure companies, as expected, did not do well. They have reported weak earnings, but the positive thing is that the earnings have not been as weak as expected. Energy companies as well have reported weak earnings due to low energy prices, but this year the markets are expecting this to change, as the oil price, for example, has already gone up quite a lot. One thing worth mentioning when looking at the numbers on Q4 last year is that we are comparing to Q4 2019 and basically comparing to the world before coronavirus even hit the Western countries. So kind of the comparison figures are, let's say, from the normal world before the coronavirus. So taking that into account, the earnings growth in the US has been quite impressive. Then if we move on to Europe, in Europe the earnings season has been slightly weaker and also slightly weaker than expected. In Europe, only 30% of companies have reported so far, so the US are a bit more ahead in terms of that. But there are a few companies already reported in Europe as well, so we have some kind of visibility to the figures already. In Europe, roughly 2/3 of companies that have reported have beaten expectations, which is basically in line with what has happened in history. That's a usual number for beating expectations. But on the index level, the earnings have been weaker than expected, and this is basically because those companies that have not reached expectations have been bigger in size. So they have a bigger weight in the index, and as such affect the index figures more negatively. On the index level, the sales growth in Europe has been minus 16% and the earnings growth minus 28%. But as said, there are a number of big companies affecting the index level figures negatively. The biggest one being the Swiss drug company Novartis, which actually reported a loss during Q4 last year. And historically, it has basically always reported positive earnings. So that was a negative surprise for the markets. Energy companies in Europe as well have reported weak numbers, but as said, that is expected to turn around this year. So in Europe, basically there are fewer good results. There are some sectors doing fine, such as basic materials, industrials and technology. But overall, the fact that European countries have put in place tighter restrictions during Q4 last year has affected the companies more than the US companies, for example, and this can be seen in these tables here. One thing worth mentioning when looking at the European numbers is also that European companies are usually more cyclical. So Europe has more cyclical sectors and cyclical companies compared to the US, for example. And as a result, the results and earnings of European companies vary a lot more than the US ones, for example. So the variation is wider over time. And if we think about what is expected from the companies this year, then actually European companies are expected to grow their profits this year by at least 20%, which is more than the US companies. So last year, European companies did not do particularly well, but the markets are expecting the earnings growth for European companies to be better this year. Then, if we look at equity markets and pricing of stocks at the moment, I've put in the slide on the left-hand side, which shows you the earnings yield of US companies compared to the yield of US 10-year government bond. And you can think of the difference between those two as an equity risk premium, which the investor is expected to receive by taking equity risk instead of just putting his or her money into safe government bonds. And as you can see, the equity risk premium has come down since the corona peak. However, compared to government bonds, equities still seem attractive, and in historical terms, the risk premium is at a, let's say, okay level. So equity markets, compared to their own history at the moment, seem a bit expensive, but if you compare them to fixed income expected returns, in that comparison, equities still seem attractive, and you can still expect to earn positive returns in the long term by investing in equities now. If the valuation is a bit high, the positive thing for equities is that earnings are going up this year, and earnings expectations actually are being revised upwards. And historically, this has been a good environment for equities. So on the on the right-hand side, you can see the number of earnings revisions upwards or downwards in the columns, and then the global equity market performance with the gray line. And as you can see, basically these two correlate quite nicely with each other. So when earnings revisions are upwards, the equity markets usually are doing fine, and when earnings revisions are moving downwards, those basically are a bit challenging in environments for equities. And right now, the signal here is positive. Then in the beginning, I mentioned that we will look at sector returns, and we expect the sector returns to kind of turn around this year compared to last year. So last year, IT was by far the best performing sector, and stable sectors such as consumer staples and healthcare did quite well last year, while many of the cyclical sectors did not do so well. So how does this look this year? Here you can see the sector returns for the US equity markets since the beginning of the year. And cyclical sectors, I would say, are doing somewhat better this year than they did last year. I've highlighted the sectors that, in my view, are considered cyclical, so energy, financials, consumer discretionary, industrials and materials are basically the ones that I'm talking about when I refer to cyclical sectors. And as you can see, some of those sectors are the best performing ones, while some sectors, materials, industrials, have not done particularly well this year. But overall, the big picture seems to be that the more stable sectors are not performing as well this year as they did last year, and there seems to be at least some kind of sector rotation going on, so that the cyclical sectors are doing a bit better compared to the market average. And of course, this is due to basically two things. The economic growth is expected to accelerate as economies are opened up and restrictions are lifted, and at the same time, the biggest losers from last year are benefiting from lifting the restrictions. And what we have done in our allocation services, for example, is that we've started to add to the cyclical sectors and have reduced the stable sectors a bit. We are doing this gradually, and the idea is that you basically won't miss the train with this one, and in our view, it's wise to make a gradual shift rather than just changing a big portion of or big share of the portfolio. There's IT, for example, has overperformed for many years, and the gap between the laggards and the leaders has come quite wide. And if we see a turnaround, you still basically have time to get on the train as it starts moving, and we've started to do that, and we are ready to continue doing this if and when we see this development continuing. That's basically the message on this slide. Then to summarize what we think about the equity markets and other markets at the moment. For equities, you have basically one negative factor. The valuation is a bit high, so the long-term expected return is lower than what we're used to during the last couple of years. However, compared to fixed income and credit investments, equities still seem attractive, and the earnings are actually quite strong at the moment, or at least they are stronger than the markets were fearing last year. So as a synthesis of these two, one negative, one or two positive things, we currently have a, let's say, neutral positioning regarding equity weights, for example, and we started to add the cyclical sectors. Fixed income, as said, return expectations are low, but we still see some opportunities, especially in Nordic corporate bonds and European senior loans. And as a result of the interest rates being so low, alternative investments, in our view, seem quite attractive at the moment. And these are part of our allocation products, for example, due to this reason. So basically the reason why alternative investments give a better expected return is the fact that they are at least partly illiquid, and due to that investors require a premium in order to invest in those. And if you're a long-term investor, you don't basically need the liquidity of the assets, so you are giving it up, but in return you're getting a premium by investing in those assets. And for alternative investments, we basically mean private debt, so direct lending, private equity investments, so unlisted equities, and real estate investments. Maybe touch just shortly on the equities. I talked about that we've started to increase weight in cyclical sectors. We also increased European small cap companies during the summer last year, which turned out to be a quite good move. Those ones performed really nicely over the second part of the year. We have decreased weight in US tech companies. We feel that the pricing currently is quite challenging, and the growth expectations going forward are, at least in our view, quite optimistic. Energy sector is something that we currently do not like. The long-term growth prospects are a bit, let's say, uncertain due to tightening regulation. And the second thing affecting those companies is renewable energy, which is becoming cheaper and cheaper every year, and it will challenge the more traditional energy production methods and technologies over the next years. So renewable energy is something that we look at and what we like to invest in, but fossil fuels is something that we have reduced. I think that's about it on my side at the moment. If we then have questions, I think we can take a few of those right now.
Sure. So I will ask a couple of questions. One of them is, of course, it's $1 million question now. Is it a good time to invest, or is it overpriced? I mean, the equity market.
Yes, we get this question quite often, and what we are recommending at the moment is to diversify over time. So if I had $1 million right now, I would not put in all of it at this very moment. What I would do is probably to invest part of it and then after 2 or 3 months invest the next lot. And if we get some kind of corrections in the equity markets, for example, I would use those to add equities and increase investments. So I would use diversification definitely. That being said, we don't expect the markets to crash or correct considerably, simply because of the fact that central banks are basically ready to step in if something seems to be going wrong with the economy. They did that last year, and investors are kind of relying on the central banks to do it again if something starts to go wrong.
Another question, thank you, is about gold. What is the outlook for gold for this year?
That's a bit trickier, at least in my view. Traditionally, gold has been bought for 2 reasons. Increasing inflation. Right now, the inflation expectations are going up, so that would, at least in my view, support the price of gold. And secondly, as a safe haven. But right now, the demand for safe haven assets is not particularly great. So there's one factor kind of supporting gold, and another one that's kind of against the gold price going up at the moment. And the gold price hasn't moved that much this year. And one thing that might be a reason behind this is, of course, cryptocurrencies, which have become more popular among investors. So some investors actually might buy cryptos instead of gold. I mean, out of those that used to buy gold to diversify their investments. That being said, gold is not really part of the universe that we invest in. We basically invest in companies either through equities or bonds, and then the alternative investments that I talked about. So in our view, gold at the moment doesn't seem that attractive.
Thank you. And before I let you go, a question also about China. Could you also give a couple of words about what are the expectations there?
That's a good one as well. If we first talk about Asia as a whole, we are quite positive on the development of Asian markets, especially the equity markets. And historically, the environment in which inflation starts to go up, inflation starts to accelerate, and economic growth accelerates, and we are expecting this kind of environment this year. That has been a good environment for many of emerging markets. And this year the emerging markets have been a good place, so it kind of fits in the whole big picture. And we are currently favoring the emerging Asian countries to other Asian markets. For example, Brazil is in a very challenging position regarding the epidemic there, as well as raw material prices. China then, it becomes a bit more trickier than emerging Asia as a whole, because when investing in China, you usually get a lot of exposure to the big tech companies that they have, so Alibaba, Tencent, and so on. And those companies might be or might face risk, or they are facing risk of further regulation, both from the Chinese authorities and concerning their businesses overseas, especially in the US. So the big tech companies in China are a kind of a question mark, at least to us at the moment. So we are positive on the whole Asian region and emerging Asia, but a bit more cautious on the big tech companies. One possibility to play this could be to invest in the A-shares market, which doesn't have the big tech companies. It's a much more diversified market, and the companies, or basically it's lacking the mega cap companies.